Hey guys, I want to talk about stablecoins, CBDCs, crypto, and just cash. Okay, the difference. Okay, I say that because a lot of people are confused. A few people, actually, I won't say a lot. I don't know. You never know who's out there complaining. But I think hopefully this helps someone. Okay, in terms of what's the difference between Bitcoin, okay, and stablecoin. Again, both coins. So Bitcoin, stablecoin. What's the difference? Oh, and then CBDCs, because CBDC is new. Okay, central bank digital currencies. They're new, and they're crypto as well. In fact, I find it funny. I remember reading this and I couldn't believe it. I'm like, whoa, central bank is going to issue their own crypto? What's going on? This is crazy. Yeah. So again, if I was confused, I worked in banking all my life. I was confused with crypto. Okay. It took me a while to sort of understand it slowly. And now just about got there, now central banks are going in with theirs as well. So it gets really confusing. So I'm talk about that, okay? And I suppose we can look at it and then hopefully I can draw the line, the difference between them. Yeah. Who am I? I'm sure you're asking if you haven't. If you don't have my app, then please just go download the app. Then you wouldn't be asking that question. And if you don't have my rings, go buy them. You won't ask those questions. So I'm the CEO of Orukka. Orukka is a smart payment ring. We allow users tap to pay. Monesave is a fintech app that allows you to save as a group. And all we have on the fintech app, instead of having your boring cards, what we do is we do rings. So the rings, so you download Monesave, you can order the rings, and then you can tap to pay with your ring. So you don't need to use a plastic card. I mean, I worked in banking for about 20 years. I can tell you, plastic cards are 50p next to nothing, and our wallets are full of these things, right? Which is quite heavy. If you go out, you lose this, you're in trouble, or someone snatches your bag, you're gone. But no one's going to snatch this. I mean, if I'm holding this, what are you going to snatch? Which is the easiest thing to snatch? This. So this goes quicker than that, right? So a lot of people ask me, I go, what if someone steals my ring? I'm like, yeah, but trust me, they're going to steal your wallet first, and you've got your wallet now. If you're not worried about your wallet, why are you worried about the ring? Right? If you're not worried about your phone, why are you worried about your ring? Because people say, oh, I can tap to pay with my phone. What if someone steals the ring? I'm like, guys, if you're number one, my battery is 5%, so you should not rely on your phone and phone should be for phone calls, or text, people you love, or social media, which you shouldn't be doing. But other than that, if you're relying on that for payment, you're already in trouble by 5 p.m., right? So you shouldn't rely on phones for payment. It was just meant to be a stopgap. But in that case, then it's the same risk. So don't worry about taking your phone and wallet out. Just go with this is less risky because it's on your fingertips. No one wants, again, if you see these thieves, especially when they're out there, they want to act fast and go. So what that means, they snatch the wallet from you, they snatch your phone off you. They're not snatching this ring off you. It's harder. And even if they do, you can block it on the app. Okay, and we have some really cool rings. So we have an AI ring coming soon. This is an AI one actually. So our AI rings have this around it. That's how you know it's AI. And then we have the bracelets as well. We're working with some people on that one. Let me just say that. And what that does then is you can actually talk to transfer money. If someone steals this, it's not going to work because he uses my voice, which is very cool. And then obviously we authenticate it so that if the voice is different, then it's not going to work. That's really cool. I mean, I'm happy with what we're doing here. We're leading the way with this very quietly as well, because again, we're in 25 countries, launched in 6 months with no marketing. This is my marketing. So, I'm very, very happy with the progress there. I say all that just to get back to this topic on what that means is we work with cash, we work with fiat, we work with crypto. And that's how I got into, the whole conversation around, how people get confused on different types of crypto. Again, we're working with Binance and Coinbase. Again, these are exchanges that do crypto. Okay. So the question is, what's the difference? Okay. So I'll start with the simple ones. Stable coins. Stablecoins is a bit like cash, okay? They're always going to be attached to some sort of cash. So they're like USDC, for instance, is attached to US dollar. A euro stablecoin is attached to a euro. The E naira from Nigeria, by the way, if you can't tell, the E naira is linked to the naira. So everything is always linked to a currency. We're trying to put together, I think, a digital pound as well. So the digital pound is linked to the pound. It's always one to one. Okay, and then obviously you're going to ask me, which people ask, and I was confused as well the first time I heard this. I'm like, wait a minute. The USDC is linked to US dollar. Then what's happening? Where's the money coming from? How are they making this money? But they make the money because they go ahead and they take the dollar that you give them, they invest it, and make more returns on it, and then give you a crypto, like a stable coin. And the stable coin only says is that when you're ready, they'll give you back your dollar. So that's all they give you. So if the risk they take is that the currency rate or the interest rates on everything they invest will keep going up. So the interest rate continues to go up on the treasuries, on the money markets, on the bonds, on anything they invest in. It must go up, of which they then give you. If you decide for some reason you want to lock up your dollar, lock up your euro with them, they give you more returns. Does that make sense? So that's exactly what we're talking about here. So the stable coins are stable in the sense that you can always get the currency, the US dollar or the euro or any other currency you wanted. If you can always get it back one to one. Okay, that's the catch on stable coins. Central banks have their own currencies called central bank digital currencies. So these are cryptos. And what that does is exactly the same as stable coin. So they're one to one against that, except that they are issued not by private institutions, because private institutions issue USDC, USDT, and all of those. Central bank digital currencies are issued by central banks, and they're crypto, one to one against their own currency. And the advantage of this one becomes that clearly it's the government that is issuing it, or the central banks. So that means they're not going to default. In fact, the private companies are more at risk because the private companies have to go ahead and make sure they invest that money and make a return. The central bank will always be able to issue their own currency. So it's a no-brainer. I'm surprised it took them this long to actually do this, right? As soon as this came up with the stable coins, I said, well, central banks need to do this. I remember back in banking, I mentioned it to quite a few people. They didn't actually, people were always nervous about crypto at that point. In fact, famously, JP Morgan, Jamie Dimon actually was one of those that said, hey, he's never, ever, ever going to touch crypto. In fact, he was threatening to kick out traders back then who actually traded or advised customers on crypto. That's changed now. So now he has his own crypto, which is backed against customer deposits. Is that the best thing to do? I don't know if banks should ever issue. I don't agree that banks should, because they can always write against the central bank. So in truth, I think banks should always carry on to become agents. They should remain agents of central banks, whereby they actually issue currencies against the balance sheet of the central bank. So what that means effectively is they can issue money. So they can write checks and go, hey, you now have a crypto against central banks debit or credit card or whatever they call it. Let's call it balance sheet, but it could be a credit card. But the point I'm trying to make there is that we have stable coins, which is cryptocurrency, one to one against the dollar, against any currency at all, and that's always going to be by a private institution. CBDCs is issued by the central bank. And then lastly, we can talk about Bitcoin. So Bitcoin, again, is specifically decentralized. It's not issued by anyone. We don't know who's issued them. It doesn't matter who issued them because it's open source. That means you can see the code. I can see the code. If anyone has messed with the code, we can see who messed up with the code and forked it and why. Yeah. And that's where, we can talk about others like ETH, Ethereum, there's Polygon, there's Solana, there's quite a few. All these guys actually have their own versions which they created from Bitcoin, right? So they coined it at some point, changed a few of the phrases. I remember Ethereum then formed his by Vitalik. So Vitalik, again, is similar. He's a private person. He decided to start his own crypto, and he raised money for it as well. And then he launched it, of which I think he's got a few sizable percentage there. The government also has a lot of that as well, which is funny. So at the end of the day, we had this crypto that everyone was running away from because it's dangerous, and now we're all there now. Okay. My point again, I don't like to give this is not financial advice, but the future as I see it is that everyone's going to just use crypto as much as we use Visa and MasterCard. Like Visa, MasterCard, no one cares. If you're going to pay for food, you don't say, I want to pay by Visa. Right? Or you don't say, I want to pay by MasterCard. Can I pay by MasterCard and not Visa? No, because to you, it makes no difference. It's just very, very small. The percentage is very small. It makes no difference to you. The way I see it, right? And maybe we'll do something. Guys, watch this space. Orukka, we might do something with our rings, right? And this should be the best way possible. You should make a payment. And when you make a payment, we should find, or the banks, or Orukka, should find the cheapest way possible to transfer your money. So if you want to make a payment to your hairstylist and you're in the UK, maybe we just use the banking infrastructure because instant payment is cheap and it's free in the UK. What if you travel to Europe? If you're in Europe, okay, and maybe you go to France and you're in the UK and you make a payment with your ring, What we might do in the future would be to find the cheapest way possible, which could be going from bank to bank. Okay, if we go from bank to bank, it might be cheaper and we can do that. Or if it's over the weekend, we can't go bank to bank, then maybe what we'll do then is we'll actually transfer money through the Bitcoin network, okay, because it's always going to be on, and move across. Or we go to Strike and use Strike, or we use Binance, right? So the way I see it is that the people on the street should not have to worry about how to make payments. It should be up to the banks to find the cheapest way possible through stablecoins, through CBDCs, through Visa or MasterCard, whichever is the cheapest way possible. And that's the future as I see it. We'll see how we do it. We might actually just do it first on our rings. So maybe we just tap to pay with your ring and find the cheapest way possible to transfer that money across. Right now, we use MasterCard. We use Visa. We use banks to bank transfers in some countries, about 30 countries. So it's a lot. Your country is possibly covered, by the way. If it's not, just let me know. Download the app. We'll get it done. We also then use Binance, Coinbase, Strike. Strike is very good for Bitcoin, but we just call their API, we call their services and transfer it across. So we have a few network or channels that we use. And the way I see it in the future is that everyone would not have to care how they transfer money across. All they have to do is, hey, I want to buy, or I want to get a Visa or a MasterCard or a phone or wherever you are. You then transfer money across, and the banks have to find the cheapest way possible. And they will take it from there. In terms of risk, interesting. In terms of risk, right? I think CBDCs are the least risky ones, okay? Why? Because Ethereum, Solana, and all those guys are owned by some people and institutions. So you're always exposed by the risk of those institutions. Stablecoins are also by some institution. So there's always a risk there. Right? CBDCs are less secure because the central bank can see what you're doing. But on the other hand, the central banks are going nowhere. So they're always going to make sure they pay you back. Okay. So that's it for now. Thank you guys, and I'll catch you in the next one. Cheers.